We want to introduce cash flow statements, but we will start with the concepts, dealing with the concepts. In a cash flow statement, we have something called the flow of funds. How do funds flow in and out of the business? When the business transacts with the outside world, funds either flow in or out of the business. This is called cash inflow and cash outflow respectively. We are not concerned about funds that circulate within the business. Let us analyze the balances on the statement of financial position, example 1, on the next slide to determine whether funds flowed in or flowed out of the business. So we'll use this example to illustrate the flow of funds. This is the example we are going to use, where it's a statement of financial position with balances for 2012 and 2013. So we'll make comparisons of the two. Changes in working capital balances. We will start with the current assets and current liabilities. These are extracts from the current assets section of the statement of financial position, as well as the current liabilities section of the statement of financial position. Changes in working capital balances. From the current assets, we have got inventory, debtors, and bank. We'll start with inventory. There was a decrease of 20,000 from 200,000 to 180,000, which means more inventory was sold during the past financial year. This represents a cash inflow to the business. We have some points to note here. An increase in inventory represents an outflow because more funds were used to buy additional inventory. A decrease in inventory represents an inflow because more inventory was sold to release funds to the business. We now look at debtors. There was a decrease of 5,000 from 100,000 to 95,000, which means more debtors paid their debts during the past financial year. This represents a cash inflow, that is, inflow of funds. Points to note: increase in debtors represents outflow because more funds were used to finance additional debtors, while a decrease in debtors is an inflow because more debtors paid their debts and funds were received by the business. Now we look at the final part, the last item in our current assets, which is cash or bank and cash equivalents. Bank is cash. Cash equivalents are highly liquid investments that can easily be turned into cash. They are not analyzed here. Its opening and closing balances are reconciled by the net cash flows from the other transactions, the other sections of the cash flow statements, where the net cash in or outflow is added to the opening balance, and this should give us the closing balance of cash and bank and cash equivalents. So we leave this to the end of the cash flow statement on the next example that we shall look at. We will see how we deal with it later. Just watch this space. Now we look at current liabilities, where we have creditors, we have dividends payable, we have tax payable. Creditors, there was an increase of 50,000 from 70,000 to 120,000, which means that there was an inflow of funds to the business through credit purchases. Creditors provides funds, that is financing, by allowing businesses to purchase without paying upfront. Points to note here, an increase in creditors is an inflow because more funds were received through credit purchases. A decrease, on the other hand, represents an outflow because more funds were used to pay creditors. Dividends and tax paid. We look at this together, the dividends and tax paid. For us to deal with this, we need to have an income statement to refer to, and the statement of changes in income. We look at this later on the next example, which has all the information. The above form part of the cash generated from operating activities. We look at that later. Watch this space. Investing activities. Changes in non-current assets balances represents the cash inflow or outflow from investing activities. The purchase of assets for use by the business for its operations to generate returns is called investing. Other investment assets are such assets as shares in other companies, buying bonds, and owning real estate, where returns such as dividends, interest, or rentals are received. So now let's look at an extract from our statement of financial position. We look at non-current assets. These are the investing. We have invested in the assets. We have got land and building, we have got equipment, and then we have got vehicles. So now when we look in the column for 2012, we had 200,000 worth of land. Obviously there was a change. We look at equipment, there was a change. We look at vehicles, there was a change. Now we want to know what really happened. Was it a cash inflow or a cash outflow? Investing activities. As we continue, IAS 7 requires that the cash flow statement distinguish between 1. Acquisitions to maintain current operations, i.e. asset replacements, or acquisitions for expanding the business operational capacity. This is part of disclosure to ensure users of financial information are informed about the investment expenditures, whether it is for growth or for maintaining current operations. Now we start with the land and buildings. There was an increase of 100,000 from 200,000 to 300,000, as we see there, which means the organization invested more in the acquisition of additional land and business buildings. This represents an outflow of funds from the business. Then we look at equipment. For equipment, we had equipment worth 140,000. This increased to 180,000, an increase of 40,000, representing an outflow of funds to purchase more equipment. Then we look at vehicles. There was a decrease of 20,000 from 180,000 in 2012 down to 160,000 in 2013, which means some vehicles were sold during the year. This is an outflow of funds. Points to note: an increase in non-current assets, that is an outflow because more funds were paid out to purchase additional non-current assets, while a decrease in non-current assets represents an inflow into the business because more assets were sold. Some assets were sold during the year to receive funds. Financing. Financing activities refers to the acquisition of funds to purchase assets of the business, that is investment. If you look at the asset side of the statement of financial position, it represents investments that are financed by the equity and liability side of the statement of financial position. When issuing new shares, ordinary or preference funds flow into the business. Issuing long-term loans and debentures is another form of getting funds to flow into the business. Ordinary share capital. There was an increase of 50,000 from 550,000 to 600,000, which means there was an issue of additional shares resulting in an inflow of funds. Long-term loan, there was a decrease of 20,000 from 150,000 to 130,000, which means there was an outflow of funds to repay part of the loan. So we started with owing 150,000, but we now only owe 130,000. So we have paid this 20,000. An increase in long-term loan is an inflow because more funds were received from issuing additional loan financing. A decrease, on the other hand, represents an outflow because some funds were used to pay off part of the loan. We get to the end of the slides, but before we end there, I want to mention that as we go into the next examples, we are going to deal with more details. For example, on the asset side, we simply looked at the balances that were there, either an increase or decrease, but we will find that there was either a sale of some assets, some acquisition there, and which there is also some depreciation that is involved there, a profit or loss there, which we are going to look at when we look at the next example that follows. Thank you.